Today, our stock analysis will focus on the large Chinese based company JD.com, ticker JD. Big name investor Michael Burry has taken a sizable position in a few Chinese companies, which includes JD. Now, since this is a China based company, as such, if buying into the company, you are purchasing American Depository Receipts, otherwise known as ADRs. So, you should understand the risk of owning ADRs of a foreign company before investing. Now let's take a quick minute and look at their financials. Starting off with revenue, we see consistent growth over the past decade, increasing more than 700% from about 18.5 billion to nearly 152 billion in 2023. Next, net income and earnings per share. Now, there have been several negative years back from 2014 to 2018, but if we go from 2019 to 2023, it's been positive and growing with an exception in 2021. But now for 2019, the net income growth is up almost 100%, which would be about an 18% CAGR, while earnings per share is up around 80%, which would be more of a 16% CAGR. So some good growth since 2019. Next for dividends, which they only recently began paying, so something we should begin tracking moving forward to see if they are increasing it over time, which they are planning to do in 2024. Then for share count, they had several years of increases, but from 2014, it is down what looks to be about 30%. So a great sign there with these stock repurchases over the decade. Then free cash flow. Not as many negative years as we saw with net income and earnings per share. And since 2016, it's been positive and increasing around 950%. So good sign that this company can generate cash. Now let's jump down and perform the stock valuation. Here's the valuation setup, and we will look at one or two other scenarios in a moment. But first, I want to point out up here in the top right, the net income and earnings per share CAGR over the last 10 years it is negative, and that's only because back in 2014, net income was negative. And when we looked at the financials, it really wasn't until 2019 when they started showing a consecutive positive trend. And from 2019 to 2023, the net income CAGR at about 18% and earnings per share CAGR at about 16%. But to be conservative, I am using only a 10% short-term growth rate over the next 10 years with a 10% discount rate and a 3% long-term growth rate. Also, because this is a China-based company and tensions with China and Taiwan, I am using a 70% margin of safety. Also, they do have a higher rate of long-term debt to free cash flow than I normally like to see. So even if you believe the China-Taiwan tensions are overblown, you should have some concern on their debt, especially since this has been increasing over the past year. Now, for the intrinsic value, I do come up with $49.10, and with that 70% margin of safety, brings that down to $34.37. And the current stock price is trading just below $30, maybe about $29.50, $29.60 or so, somewhere around there. So definitely seeing a value opportunity, and I understand why Michael Burry is investing. But let's look at a few other scenarios first. And let's just say you think my 10% short-term growth rate is on the lower side, that there's still more growth for JD. They're still growing, as we saw. Their revenue has increased every year over the past 10 years. So let's just say there is still a good amount of growth, and I'm going to change my 10% short-term growth rate to 12%. Now with a 12% short-term growth rate, intrinsic value jumps up to $57.60, and with that same 70% margin of safety, brings it down to $40.32. So definitely good signs here if you have more of a bullish outlook for JD. Definitely some opportunity, but definitely a lot of risk investing in JD and a China-based company. Now, let's take the other side of the coin. If you think my 10% short-term growth rate was a little too optimistic, let's lower the short-term growth rate to 8% and see how that plays out. With that 8% short-term growth rate, intrinsic value drops to $41.87, and with that same 70% margin of safety, brings it to $29.31. So again, I definitely see why Michael Burry is investing here. Even if we're using a lower short-term growth rate, there's still opportunity here. But for me, I will probably hold off investing in a Chinese-based company. But let's look at a few other data points before we move on. And the first one, I'm going to look at the PE ratio, 13.5. So definitely in that value opportunity range. Then long-term debt to free cash flow, we already discussed that. It is on the higher side, at least for me. I like seeing companies under 3. We can see they're just over 5. The dividend growth, they only just started paying dividends last year, and this year it is growing about 20%. I think it's going from like 60 cents to about 74 or 76 cents for 2024. But this does give a dividend yield of 2.6%, so not too bad. And the share count, as we saw in the financials, it is going down. It's dropped almost 35% over the last 10 years. And then net profit margin. This is lower than I like to see. I like to see companies at about 10%. So we can see over the last 10 years, net profit margin basically just under 1. And for the last 3 years, basically 1%, but they do show a lot of revenue. They're just not turning that into as much net income. And the only other data point we're going to look at here, and something I always like looking at for a stock, is return on invested capital. And again, I like seeing 10% or higher. We can see this is on the lower side in that single digit range. 10 years ago it was negative. They had some negative numbers back then. But 5 years ago, okay, 8.3%. But then 3 years, 2.5. Then the 1 year, basically at 6. So I would like to see that a little higher. But they have some other good data points like we saw before. Continuing growth with revenue, free cash flow was not bad. But let's move on and we'll look at my portfolio's performance so far. Here's the portfolio's overall performance and look at the results of a few. So first, NVIDIA, NVDA, bought into the stock earlier this year and is performing very well with a really good earnings call the other week and announcing a 10-for-1 split sometime in June. Though I probably would not be adding to this position at the current price. Next, Palantir, PLTR. This week it was announced that they won a $400 million DoD contract along with other ongoing work that they have. And I'm still bullish and adding to my position while the stock is in the low $20 range. Then Advanced Auto Parts, AAP. They are still going through a turnaround, and though the Q1 results from earlier this week weren't great, I still have a positive outlook with the expectation that the turnaround story should start showing in their financials in the second half of this year. Then Smith & Wesson, SWBI, they should be having their Q4 results sometime in June. I'm looking forward to that as I am expecting an increase in their free cash flow now that they've finished building their new headquarters in Tennessee. So hope you enjoyed this video, got some useful information. If so, consider subscribing. Hope to see you next time. Thanks for watching.